Patrick, it's the kind of sell everything except those three stocks and buy them market. And that's in essence
Yeah.
what's happened. There's nothing going up. Like some of my buddies, they're telling me, they're saying, I get up every day and I go and look at my screen and like almost all of it's red except for those 4 stocks or 5 stocks.
Absolutely. And the interesting thing is, okay, so S&P 500 literally is like within what, 10, 20 points of its highest intraday print. And if it closes here, this is going to be the highest close that it's had. No, actually, it closed higher yesterday. But still, the point here is we're literally within points of closing near the all-time high. And when you look at the breadth of the market by looking at the percentage of stocks that are above their 50-day moving averages of the S&P 500 stocks, we're at 43%.
Yeah.
That means 57% of S&P 500 stocks are downtrending, outright downtrending.
It's absolutely crazy. It is a
right?
very, very unusual market.
And this is where I think that this is an absolutely valuable time to really assess, how you want to be positioned in these markets. And the interesting thing, Kev, like I'm doing a special webinar on portfolio hedging, and I think that this is such an interesting moment to actually put it on, because there's at some point Nvidia and Apple are just like when you shoot a rocket up into the sky. At some point, the fuel runs out, and it's just and under its own weight, it will just mean revert. I don't want to say anything bearish in terms of like it's but it's going to mean revert. It just can't keep going parabolic without at some point correcting. And when that happens, though, that's probably going to spur a much bigger stock market correction. And the crazy part is that right now to buy portfolio insurance is still ridiculously cheap.
It is crazy,
And
isn't it? Like there's like
yeah,
the fact that here we go, and it's actually when people are the most bullish, they're the least interested in buying insurance, and yet it's when it's the cheapest, and it's when they should be buying the most likely to buy it.
yeah.
So Patrick,
And so
before
here
you go, I'm gonna before you keep going about this, when is your webinar?
So the webinar is on Tuesday at on June 18th at 11 a.m. And you could just go to bigpicturetrading.com to the website, and it's right on the homepage. You can register for the webinar,
So
and if you can't
completely free?
attend it live, completely free. And even if you can't attend it live, the recordings is sent out to all registrants, so you'll be able to see it no matter what. And so I wanted to just touch on why I think it's such an interesting thing at this moment. So, Kev, this is the chart of the 1-year volatility index. I'm going to put it actually on a weekly chart. And just we're not talking about hedging with a 30-day option. Like, the 30-day VIX, the standard VIX index is just telling you what hedging for the most immediate downdraft is, right? But if you go and just do portfolio insurance farther out, it has not been cheaper from a vol perspective to buy a downside protection since COVID. Like this is the cheapest it's been in almost 5 years.
Right. And then when you combine that, there's also another reason in terms of as a percentage of the underlying, it's cheaper than before COVID, right?
Absolutely, and absolutely, and there's a second component which I'm going to be talking about in the webinar is the fact that interest rates being as high as they are, because the Fed hasn't started cutting yet, means the forward price of the S&P is higher, making the at-the-money put options actually that much cheaper. And that's a concept that we'll explain in greater detail. But it's like literally right now, the biggest issue always is that everyone might think that it's a time to do some selling, but there's always challenges to selling, whether it's tax implications, trading restrictions, or just in the complexity of doing it. Why so many people often simply stay invested because it's just too complex. But overlaying insurance means that you don't have to to do any of the selling. You just need to position yourself that you have that tail risk insurance that reduces the volatility of your portfolio and allows you to hold through things like this.
Got it. So
Yeah.
Tuesday, June 18th.
Tuesday. Shameless plug. Thank you, Kev. The
Big Picture
the
Trading.
one thing
Make sure
though,
you go check it out.
but
Completely free.
but the one thing though, Kev, I wanted to segue that into this conversation about the pain trade. A lot of people today are the market's it's an election year, it's this, it's that. Everyone comes up with a reason when the market's at its highs why it can't go down. But the thing is that back in 2023, there was no shortage of bears anchored off of the regional bank crisis and the yield curve steepening, and there were
reversing, not steepening.
No, it's
Inverting.
Inverting,
Yep.
and like it started to revert back to being positive from an inversion.
I see. Okay, I didn't understand that.
That's
okay,
what that because
Yep.
it was deeply negative, right?
Okay.
The twos tens.
Yeah, I hear you.
And so the thing is that everyone was bearish. Everyone thought everything was going down. But the one thing that I've learned from 20 plus years of trading is the market never crashes when people are planning on it.
Yeah.
It's like the one rule that you can live by is that if everyone plans on something or expects something to happen, it never does. And it's the idea of the pain trade, which the market will take the path that causes the most discomfort or financial pain to the largest number of investors. You basically need, in order for there to be a liquidity event or a market turn, you literally need everyone on the wrong side of the trade.
Well, we're getting there.
And all together on the wrong side of the trade, and they all try to run for an exit door at the same time. And the thing is that when I look at compared to the regional bank crisis and all the other stuff last year and how everyone was positioned versus how everyone's positioned today, I can't find anyone who's excited about being short.
Oh, I completely agree. So I can tell you, Patrick, I used to go and try to say the economy's not so bad. Everything's going to be, it's not going to be as bad as you think it is. There's the fiscals, is way stronger than you might expect. And everyone kept telling me, you don't understand the yield curve. You don't understand this. You don't understand that. And now when I start saying, listen, things are kind of frothy, you should be thinking about the other way. People just tell me, no, it's going to keep going up. There's no reason to fight it because it's going to continue forever. Yeah. And to your point, like rockets, they don't, go forever. They eventually fizzle out. And I think that the bigger issue is the fact that there's so many of these just absolutely insane stats that you're seeing in terms of whether it be the concentration of those three names, I saw that Sentiment Trader had this post the other day in terms of he called it the information ratio, which I believe is against a benchmark. So I'm confused why he would do the S&P 500 against an information ratio. But in essence, if you look at like a Sharp for the S&P 500, meaning the returns adjusted for risk, we've almost never had this sort of rally. This is the kind of rally that is hugely overbought on a risk adjusted basis.
Yeah, it's absolutely insane. But you know what? It still can continue. Like, I mean, it's not like me and you are here saying that today is the top, right? Like it could be at 5,600. Nvidia could be at 135. Apple can be at 240. And this can be the story 2 weeks later when we're recording the next huddle that the market is still up along its highs.
Nvidia is going to be 135 this afternoon, buddy.
That's no shit. The way it's going, but what is interesting about it is that it will at some point peak out. We don't know that it's going to happen now, but this is the whole point of insuring yourself. Right? Anyway, I'm not going to go back on that.